Hi guys, Adoni here again, and welcome to another video where I basically show you guys different and structured ways to look at the market. And again, I would say this is no way the ultimate way, but this is the Adoni way. This is you looking at the market through my lens. And if you like my videos, please do well to subscribe and like this video if you enjoy watching me, as I'll be encouraged to put out more. So without further ado, let's get right into it. So really just want to talk about order flow, right? I want to talk about how I see order flow and how I use order flow in the markets, right? Because I get a lot of texts from people, oh, how did you get this trade? How did you know this was gonna happen? And all of that. So let's just get right into it. Now, firstly, just for a bit of context, right? Order flow is just basically the real-time movement of buyers and sell orders in the market. It shows you who is in control, either the buyers or the sellers. Now, just I want you to think of this like price doesn't move randomly, and you really need to know that price doesn't move randomly. Price has a reason for moving. And price moves because orders have been executed, either by the banks, institutions, or even retail traders placing buys and sells. And order flow is the study of that activity, right? And at any moment in time in the market, there are two things happening: buy orders or sell orders, that is demand and supply. So what demand does is it pushes price up, and sell orders, which is supply, pushes price down. Another flow is just basically tracking this battle in real time. And now, before we really go deep into um the chart to show you how I look at order flow, because obviously I don't use the footprint charts, which is more of like the best thing to use when it comes to order flow, because this shows you in real time the orders that are being executed in the market. But I use candlesticks. I use mitigation orders to actually understand what or where the order flow is. And we'll get to that in a bit. But you need to understand why order flow matters. Most retail traders only look at candlestick patterns, they look at support and resistance and indicators. But indicators are lagging reflectors in my own view, right? You can observe order flow in different ways. You can observe that with the order book, which I don't use. I don't use time and scales, sales. I don't even use volume profile, right? But I've just found a way to understand order flow, right? And this is just basically the successive mitigation of orders. And that's what we'll be looking at on the chart today. And as always, I'll be using gold because that's my baby, right? So the way I look at order flow, right? Firstly, I want to it shows up as break of structure. It shows up as rejections, which could mean absorption of orders, and also shows up as liquidity grabs, right? Stop ons by large players and all of that. So even if you don't use the order book and all of that, you're already reading order flow indirectly through price. That's what you need to know, right? Now let's take a quick example of that. So for example, let's say we have buyers dominating the market. So let's say we have a strong level at this point, at the bearish strong level, and then we have price breaking this level, right? Strongly with momentum. Remember, with momentum. What this means is that there are buyers situated around this area. Why is that? Because, like I said, you can actually understand order flow by using break of structure, rejections, and liquidity grabs. Now, in this context, we had a liquidity grab, right? We had a liquidity grab here, and we had an eventual break of structure. Not just only a break of structure, but also a break of trend. Let's just call it. Just this area, this whole area has been broken, right? In my terms, this is a multiple break of structure, which is also very good to see. Now, what this shows is that it has multiple buyers dominating this current price action, and there is bullish order flow. Now, stay with me, right? Now, what happens next? We now have maybe instead of continuation, we now have price weakening above this high and then dropping. What this means is that around this area, there are sellers that are opposing the buy momentum coming from this level. Now, this is what the battle means. Like we might have like maybe a supply level, right? Let's say a bullish candle right here that was absorbed. Then we now have a bearish candle right here. Yeah, let's just visualize this. So you have a bullish candle, right? A bearish candle. Obviously, this is like more of like another block, but you could also call it a supply level, right? So we have a level right here. The price is now rejecting. Now, this is not random. This is not random. Why is it not random? Because they only did not just reject from here, but they took out liquidity at this point while also absorbing the buy orders that are coming from this level, right? This move is happening with a lot of injection of buy orders coming in, right? So typical supply and demand. When demand, right? Let's do this. When demand is greater than supply, what happens? Price pushes up, right? Now, and when supply is greater than demand, what happens? Price pushes down, right? It's just that simple. So you have, for example, on gold, you have 1,000 sell orders at 4,565, and then on that same gold, you now have 400 buy orders at that same price point, 4,565. What this means is when you look at the supply order, sell orders coming in 1,000, and you look at 400 buy orders, what is more? The sell orders, right? Meaning price will sell. But this is not just a this is just a contextualized stuff. Now let's put it into real practice. At this point, this move coming in here, right here, this exact move, this push from this low, right, add buy orders. And then at this exact point inside of, where's my text? Inside of this supply, we have 1,000 unfilled sell orders. A 1,000 unfilled sell orders rest inside of this supply zone, right? And this 1,000 unfilled sell orders is a result of imbalance between the previous buyers and sellers within this range, and that is the reason why maybe we had a push to the downside from this level, right? So let's do this. So that's why we had a push to the downside from this level. So now that we've had that push to the upside, the moment this push happens from here, let's just say it happens from here, and we have this push, we now have maybe the imbalance that occurred in this area could be maybe plus. Maybe we have plus 400. We have plus 400 buy orders. So meaning the momentum coming out of this resulted from an imbalance of sell and buy orders with 400 buy orders more. What price is doing is price is going to seek supply to fill these orders, and if it does not get supply, it's going to keep pushing up. So the moment price comes to this level, which has 1,000 sell orders, these 400 buy orders will be absorbed. Now in order flow, there's something we call exhaustion and absorption, right? the moment price comes here, let's say at the moment price comes here, we have 400 buy orders shooting price up. But the moment price gets to this point, we have maybe 200 buyers left in the market. 200 buy orders. This means that at this point there is exhaustion already, right? But we are coming into a zone, and this zone has 1,000 sell orders. What do you think will happen? This sellers, 1,000 passive sellers waiting, are going to absorb these 200 aggressive buyers, right? Passive orders rest in limit in supply and demand zones, while aggressive orders are guys that are just actively market executing in the market. It's just that simple. Now we have 200 aggressors currently still in the market as buyers. They meet with 1,000 patient passive sellers waiting to absorb and get orders to fill their sell orders. It's just more like 200 guys are coming to sell to buy yam, and they meet 1,000 guys that have yam available. What do you think would happen? There's abundance of yam. The price of that yam will drop because there's competition. So everybody wants to sell that yam, right? Everybody wants to sell that yam. So what happens basically is that these 200 buy orders get filled by these sell orders, and then we have a resultant of what? We have a resultant of 800 sell orders left. What happens? Price then sells as a result of the imbalance between the buyer and buyers and sellers, and it will keep selling until it is what? Until it is absorbed by another demand zone that has the available. So for example, let's say we get all the way, we take this 800 sell orders back down to this demand that has now been created. This is how the battle occurs. This is just the simple definition of order flow. Let's say we now take these sell orders, 800 passive sell orders filled. We now have 800 left. Price would sell, and the reason why price is selling is looking for liquidity. And liquidity is not just lows. Liquidity also rests within demand and supply zones. Liquidity just means money, and money means orders. Orders mean money also, and this is how volume is generated within the market. And that is why you say without liquidity the market wouldn't move, and that is true, because market orders rest within demand and supply zones. They rest within lows and highs, which are the pivot points or swing points, right, of the structure of the market. You need to actually understand order flow for you to be able to understand this. So we bring 800 sell orders into this demand zone that has 400 buy orders. What happens? Price is still saying, oh, we have 800 sell orders. Price, by the time price go here, we had 600 sell orders left. They had been filled, while coming down, and then we had 600 left. That 600 sell orders is still more than this 400. What do you think happens? It absorbs it, but we still have 200 sell orders left, meaning that the same momentum is still there. It drops. And the reason why it drops is not random. It is dropping because the order has not been filled. Demand is not yet greater than supply for demand to push price higher. This area, this zone is not strong enough, right? Is not big enough, is not capable enough to absorb this 800 or 600 orders coming in. Therefore, price absorbs it, looks like it's pushing higher, but it drops back because the sell momentum is still in the market. And then this is where you now see a demand failing and then price coming to a new demand, picking that demand and then pushing higher, because somewhere within that demand we might have orders resting around that area to absorb the 200 more sell orders coming in. And then we now see a push. This is me explaining what you see in real time on the market, right? This is order flow. It is the balance. It is a study or the concept of the balance within the market, right? Now, I hope I simplified this to make you guys understand. Just think of it as a marketplace. You go into the market. Before going to the chart, just understand that before you go into the market, you want to buy. Currently, I'm in Nigerian, so okay, I'm in the market. We go to an Indomie depot shop to go buy Indomie, right? And now this is a depot shop, meaning okay, it is going to be cheaper. And maybe it's a distributor. You go there, you have the intention to buy 10 cartons of Indomie for Ramadan or something. You want to share it. Then you get to the depot, and what they have available left because they're out of stock is 8. Now, demand is saying give me 10. Supply is saying I have 8, which means there's scarcity. It is not enough. And they know that a lot of people don't have Indomie because you are at the depot that serves that area. And if you don't buy it, someone else will come and buy it because there's scarcity. And the depot person recognizes the fact. What do you think would happen? The price would shoot up. Now, for example, you're not the only person that comes there to buy the Indomie. You want to buy 10, someone else is there that wants to buy 9, someone else is there that wants to buy 5, someone else is there that wants to buy 4, but there is 8 remaining. The price of that Indomie, even though it is not meant to rise up at the time, rises up because of the competition that is currently available for those 8 cartons of Indomie, because demand is greater than supply, so price will buy. And this is the force that rules the market: demand and supply. Demand and supply will always, it is a principle of market, it is not a method of market. In another video, we'll talk about how I understand the principles and the methods of looking at the market and putting them together to actually form a very good strategy, right? Because there are principles of the market and there are methods of looking at the market. The principles will never change, methods will change and evolve, principles will never change. Is that understood? So now this is just a simple explanation I can give when it comes to order flow, right? So let's talk about money transfer, because money transfer to me is also part of order flow, right? So let's clear this and talk about money transfer. Now, when you talk about money transfer, it is just the transfer of liquidity from one point to another, right? It is a transfer of orders from one point to another. Now, take a look at this bearish trend. We have this move, we have price going all the way here, and then we have this. Take into context or take into consideration the concept I explained to you earlier, where we have two supply zones. We have one here and we have one here. Now we have a break of structure, obviously, at this point, and then we have price developing a bullish order flow as an incoming retracement structure to come and mitigate this area. So at this point, we now have this happening, and then we have push to the upside. Let's make this gray. Now, what am I trying to explain? You already know that in a bearish trend, we create lower highs and lower lows and all of that. And in a bullish trend, we create higher lows and higher highs. Now, not that I'm going to be explaining ERC and ECR and ICR in this video, but this is just a simple context of the ECR and the ICR, understanding the relationship between the internal and the external structure. It is very important. Now, when you add order flow to that, it makes it very powerful. Now, how do I impute order flow into this? Currently, we can see that price is trending higher. This is basically the order flow of the market currently. These areas that we see here are external ranges that order flow is being played into. So we have a range, and then we have the order flow playing into the range. And the order flow determines or decides the direction. So now we know that we have taken out liquidity, and then we've mitigated a demand zone here, causing price to rise, meaning that we have demand and bullish order flow in the market currently. Now, for example, here in this supply, we have 5,000 sell orders, passive sell orders, right? And then here we have 3,000. It doesn't even need to be more than it. Trust me, 3,000. Now we have 3,000 passive sell orders and 5,000 passive sell orders. Stay with me. Now, the moment this area got mitigated, we could say the weekly is the red structure is the weekly and the green structure is the daily for context. So now we understand that we're in a bullish order flow and we have mitigated this. Now, money transfer happens when we take liquidity from an area or we mitigate a key level and creates a move. Now, we need to have a break of structure of that move. If we have a break of structure here and this mitigation happens, this break of structure is created by this mitigation. You will see my chart sometimes I do like this. It means money has been transferred from this low to this high because this low created a new high by mitigating a previous low that had demand within it, meaning we have orders here that are still sustaining the bullish move, right? Meaning that the sell coming from this area was not enough to bulge this area, absorbed all the sell orders and still had enough to push price above here. Does that make sense? So now we now have, aggressors coming into the market and giving us, push to the upside, push to the upside. And then we have this. Then we have this push to the upside. And we meet up with 5,000 passive orders here. And then you have this happening. Boom. But price fails to close out this high, this low, right? But let's say it takes it out and then it comes into this demand zone. Remember, there is demand, there are orders inside of every demand zone we have inside of a bullish move. The question is the demand carrying enough buy orders to sustain or absorb a bearish pressure? Now, for example, we come from here, we absorb 5,000 passive orders, and that order pushes price down, violates this demand, meaning this demand does not have enough demand to absorb or overwhelm the sell orders coming from here. But we come into this demand zone like this, and this demand zone absorbs every sell order just enough to push price back above this high, meaning that the demand has sustained this supply. And money has been transferred from this high to this high, right? Also, money has been transferred from this high, from this low to this high, because every order here has been absorbed enough to push price higher. Every order here has been absorbed to push price lower. It broke a structure. Money has been transferred. So if we were going to continue lower, right, we were not meant to close above this high, but we did. And that close was sponsored by the mitigation of this low. And it was sustained, meaning the bullish pressure is still sustained. This is more the reason why sometimes you guys take sales from supply zones and it gives you a change of character and you're like, yes, we are selling, but then it uses this to push back up. Why? Because the bullish pressure is not yet exhausted. We still have orders around here that still want to push price. And then you now see price do something like this, continues the bullish move until it gets to a point of interest that has enough orders to then continue pushing price to the downside until it meets a demand zone that has enough orders to want to push it back to the upside. It's not really simple, but yeah, it's that simple, right? So let's go into the chart to show you just a quick example of what I'm talking about on gold. So now we are on gold chart on the weekly. Now, like I always say, the first thing I do when I come to the chart is to understand the trend and the environment that I am in. And this helps me to understand the flow that is in the market, right? Currently, on that current time frame. Now, when you look at gold on the weekly time frame or on the daily time frame, what do we have here? We can see that we had this, I give this low by coming into this demand zone. Now, what happens here? Money transfer. Why is it money transfer? Because it closes above this high at the least. We had sellers come into the market. We had price come into this demand zone. We had a rejection. Remember, I talked about rejection also as a way of looking at order flow. Now, this rejection in candlestick pattern, you see just a rejection. When you use the footprint, you'll be able to decipher to see if it is actually an exhaustion or an absorption of orders that happened here. Most times, both happen. Now we have this happening with a weak rejection, and then we have price pushing higher. Note that we have supply here. It was what? It was invalidated. Note that we have a demand here. What happens? The pressure keeps on, and we push higher, right? We keep pushing higher. We have another demand here that sustains price, right? Breaks a high, and then we keep pushing higher. When we break this high, what that means is we have transferred money from this low right here to this high. Right? What that means is now that we've transferred money from that previous low to this previous low to this new low, meaning that price should not break this low if we are to respect the bullish move. And what happens when price keeps coming down? We meet again with a new demand area within here, this whole area. What happens to it? Respects price, right? It respects price and pushes price higher, meaning that even internally, we have transferred money from this low to this low. Remember, it also took our liquidity. It's always there. It will take our liquidity. Now, this, you might be thinking, oh, this is not a structural. It is a swing low. Look at it. Using three candle formation, it is a swing low, and also it is a major liquidity. It is a daily low, meaning it is a liquidity that can be taken out. Took it out, respected this low, broke the high. So if we are going to continue, meaning that if we are actually going to continue into this range or go deeper, we first have to take out this low, meaning that this is no longer valid, right? And that is where order flow comes into play, where you know that I know that because this money transfer has happened, every single low that is mitigated or of the same degree within this area is now what? Is now also liquidity. And that is how I can tell that the next area of mitigation within this leg, this low that was protected, is this level here. Right? Because I know that within order flow, this area is complete. It has fulfilled its obligations here. And if we are going to continue higher, you can see that even before we came lower, what did we do here? Go back to the daily time frame. What did we do here? We mitigated some sort of demand inside this whole area. Now, because this is the low, even if this is your demand right here, so far it doesn't take out this low right here. We are still in business. What happened? Price came all the way. After this move, it pushed higher, right? Created liquidity, never mitigated this because this is a week to week. You need to know. Now, it never mitigated this, created a liquidity point. Also, what? A daily low, which is a very major liquidity. And then we created a high. The sell pressure came. I need you to understand this. Sell pressure came into play. We sold lower, but couldn't break this demand. Order flow. Now, the moment this happens, money is transferred again from this low to this high. I'm sorry, from this low to this low. Why? Because this low has respected a demand within this low and has gone forth to break structure. Now, this is daily. You might say, oh, it didn't break this high. Yes, but it broke multiple structures. We developed a bullish order flow. We broke one, we broke two, and we broke three structures from there. Meaning that for me, if we are going to go lower again into the range, we have to break this first. And that is how I know. And that most times when you see me trade and I do something like this is it here, the trend. And this is how I marked out my trend on the to know that the bearish move had started, right? So this is order flow right here. So now we mitigate this demand, and naturally this demand should be enough to break this high. But what happens? Price says no. We have a supply right here. This is a supply. This huge supply. Now, this is just for context. It does not mean, no, I took my trades from here. No. This is just for context, order flow. This demand pushed price into the supply. Supply had enough move to at least push price down, and then aggressors came into the market, and there was no supply capable enough to do what? To sustain this move. And what did we have? We had a break of this low, and the next demand that price encountered was this demand here on the weekly time frame, like I mentioned earlier. And what did we see price do? Price absorbed. Now note this, it took out liquidity, right? It rejected. Do you understand now? It rejected, it took out liquidity, and then going back to the daily time frame, what do we have? It broke a high. Where is the high? Right here. We broke this high, right? Order flow. Now, again, in a bullish environment, what do we have? What do we expect actually? We expect demand to be respected and supply to be broken. Now, let's look at this area for the same order flow move that I'm talking about, right? Let's clear the chart. So now let's look at this area that we have right here. Going to the 4-hour time frame. It can be replicated on any time frame. Just make sure you know what you're doing. That is the key. So now we had this rejection from the weekly demand somewhere around here, and then we developed bullish order flow. Now look at this. In a bullish environment, right? In a bullish environment, we have higher highs and higher lows. So we have this high, higher high, higher low, higher high, higher low, higher high. So now you're asking yourself, within this move from this push to this high, every demand there can be respected using order flow. And now when we're talking about market transfer, you can see that within this move, you will see that every demand has been mitigated. Push. So we have this demand mitigated, transferring money from this to this. Then we push, we break a high. Then we have price coming to this low, transferring money to this. And then we have this push again to the upside. It didn't mitigate. Now, this is where the money transfer fails, because at this point, this area was not mitigated by this low, thereby saying that this demand right here has not been mitigated, meaning money has not been transferred from this low to this low. No, money has not been transferred from this low to this low, because there has been no mitigation of demand within it. Instead, they created a liquidity and left that demand, meaning we still have resting orders here that have not been taken. That's what it means. We still have resting orders here that have not been taken. However, this area has been mitigated, this low to this low, right? Because price came into the demand. I need you to understand this. It is very key. Price came into the demand, mitigated it, pushed high, broke a structure. Price came here again. We have a demand in this area, mitigates it. What happens? Breaks structure. So every single point here, money transfer, and then we come into this area, we break this low, which is the last low that needs to be broken, because now we've transferred money from this whole area to this area, and this is where you see me draw a trend line that goes from here to here, because everything has been broken, everything has been mitigated. So once we break this trend line and we break this low, for me, price is wanting to seek, because now we are having sellers coming. For me, what that means is price is coming to seek liquidity. Liquidity doesn't only have to be lows or highs. Liquidity is money, and money rests inside demand and supply zones also, right? Money rests inside supply and demand zone. So this is money. This itself is money. You understand that? So now what happens here is that this demand zone has enough volume to push price back higher. And some people are, so you would ask yourself now, what happened? Why is this sell happening now? The sell is happening simply because if you go back to the daily time frame, now this is a different way I look at the market, because you would see that we had this area right here, right? This is more of like a flip zone where we have a support, a previous support now has now become resistance, right? A previous support that has now become resistance being mitigated. It is also a key level. A previous support respected once, respected twice, and then broken. Now it is fresh. We can use it. So they move from this area. Sorry, they move from this area here, met with a supply here, and that supply pushed price down, violated demand that was here because they had all been filled, so they didn't really have much left in them. It needed an imbalanced level that had enough demand to absorb the sales coming from this area for it to be able to push price back up. And what the price do? Price met with this, push price back up. Ask yourself again, where is the supply that price used to absorb whatever buyers coming from this level were? Now you ask yourself, and this is the answer. We have another open close level here, right? That price used to push price lower. If you go to the daily time frame, you see. Now go back to the 4-hour time frame. Some of you say, but there is no level here that price can use this and that. That's why I don't only use order blocks. I use support and resistance also. The market is dynamic. It is unique. You don't need one specific kind of level. I use FVGs, I use order blocks, I use breaker blocks, I use key levels like supply and support and resistance you see here. So you really need to understand the dynamism, right, that order flow offers you in your strategy. Once you can understand order flow and put it with market structure using liquidity, there is no way you will not win in this market. There is no way you will not at least be profitable, if not consistently. Because consistent profitability comes with discipline, and it comes with understanding and being comfortable with what you know, right? So this is the reason why I could have taken trades from this level, because I understood what order flow is, and I still understand what order flow is, right? Now, order flow doesn't mean, okay, you know this demand could hold price and you take a buy from here immediately. No, you need to have other components and other aspects of your strategy that allows you to, take trades once you understand and you see what is happening between supply and demand, or support and resistance. It is very key, right? So with that being said, I hope I have been able to explain to you and show you how the dynamics between supply and demand play a key role in our day-to-day trading activities, because it is just simply the the tussle and the tug of war between supply and demand, and whoever wins gets to control the market. So that is how I view supply and demand. And I need you to understand that when it comes to supply and demand, there's one thing that you need to know. It's called the passive orders and the aggressive orders. So passive orders basically exist to stabilize the market. They exist to stabilize the market. And these are orders that you see inside of demand zones that I've explained to you. However, aggressive orders or aggressors, whatever, are active market participants. They are currently in the market, like they are buying, always buying, or selling. They could be the scalpers, they could be the ones that are executing market. Maybe market has left them this and they want to enter the market. These are aggressors. They are not waiting for limit orders to be filled. So you can put passive exits to stabilize the market, right? And aggressive active participants that drive price. And with this being said, I hope I've been able to convince you and not confuse you about the importance of order flow in trading. I use it, you can use it. Watch this video, understand it with the context and with the ideology that I've used to explain it. I hope you can understand from here on. So please like this video, drop your comments down below, and tell me what topic you would like me to touch on next. See you guys in the next one.